Welcome to Value.Daily. Today, we are diving deep into Circle, the powerhouse fintech company behind USDC, which you know is the world's second largest stablecoin. And wow, what a day to be talking about them. The stock, CRCL, has been on an absolute monster run this past year. But today, it just slammed into a brick wall. The headlines are screaming, alerts are probably going off all over the place, and it's all because of some new legislation brewing in Washington. But here's the real question we're going to dig into. Is this a genuine threat that could cripple Circle's business? Or is this just a massive market overreaction, creating maybe one of the best buying opportunities we've seen all year? We're going to break down exactly what went down, what the market is getting completely wrong, and why this story is so much bigger than one scary-looking price drop. Okay, let's just start with this. This is the number that has everybody's hair on fire today. A 19% drop right from the opening bell. We're not talking about a slow decline here. This was a straight-up nosedive on huge volume. Now, if you're just scanning the headlines, they'll all tell you the culprit is this new bill called the Clarity Act. The story out there is that this bill is basically designed to destroy the reason for holding stablecoins like USDC, gutting the entire model. But as we are about to see, the headlines are telling a dangerously incomplete story. And the market, well, in its rush to sell, it seems to have missed the entire point. You know, somebody posted something online this morning that just perfectly captured this whole situation. It's this simple three-part framework. First, what scared the market? It's this one idea buried deep in the new bill that you can't earn passive interest on USDC anymore. Okay, scary. Second, what actually matters for Circle's billion-dollar bottom line? We're going to show you the numbers, their own financials, and spoiler alert, it's completely unchanged by this. And third, what's actually bullish for the company's future? Believe it or not, it's the regulation itself. Yeah, I know, it sounds totally backward, but trust me, this framework is our roadmap. By the end of this, you'll see why this drop might just be a classic case of short-term fear, totally missing the long-term, rock-solid picture. So let's just put some hard numbers to the pain. As of today, March 24th, 2026, Circle, ticker CRCL, is trading around $102 a share. That's a drop of almost $24, erasing nearly a fifth of the company's entire value in just a few hours. This isn't just a little dip, folks. This is a major market event. Billions of dollars in market cap just gone. The speed of that drop tells you everything you need to know. It was driven by pure emotion and trading algorithms, not by careful, thoughtful analysis. And that, right there, poses the big question for us as investors. Is the fear justified, or is it a gift? So in this first part, we're going to deconstruct that panic. We're going to get inside the head of the sellers and figure out the exact fear that triggered this massive sell-off. The goal here is to really separate that headline noise from the financial reality of how this company actually works, so we can pinpoint exactly where the market's logic just completely fell apart. And that brings us right to the heart of it, the Digital Asset Market Clarity Act. This is the bill that crypto investors have literally been waiting years for. It's supposed to bring order to the chaos, finally give us clear rules of the road. It's supposed to be a good thing. But one tiny section in the newest draft sent total shockwaves through the market today. So let's break down what this thing actually does and why one little piece of it was so badly misinterpreted. Now, it's super important to remember that the Clarity Act didn't just appear out of thin air. It's really the second part of a 1-2 legislative punch. As you can see on this timeline, last summer's Genius Act already put pretty strict rules on stablecoin issuers like Circle. It forced them to be backed 1-to-1 with super safe assets, like cash and government bonds, and demanded regular audits. So that was step one, make sure the money's actually there. The Clarity Act is just the next logical step, trying to define the rules for the whole ecosystem. This isn't some surprise attack. It's the end of a long, very public process to bring digital money into the mainstream. So let's look at what this bill is really trying to do, because honestly, it's overwhelmingly positive for a big, established player like Circle. First, it finally answers the biggest question in crypto: who's in charge? It splits things up between the CFTC and the SEC. That turf war is over. Crucially, it creates this special, clean category just for payment stablecoins, like USDC, putting them on totally solid legal ground. It also sets up a lighter touch for DeFi, which is great for innovation. And then there's this huge one. It straight up prohibits a Fed-issued digital dollar, a CBDC, which would have been Circle's single biggest competitor. It's all good stuff. And then we get to Section 404, the little section that defines the rules for yield and caused all this chaos. And this slide, right here, illustrates the market's huge misunderstanding. The new rule bans paying people interest just for holding USDC in a wallet. Basically, it stops stablecoins from being marketed as if they're the same thing as a bank savings account. That's what regulators wanted. And that is what the market freaked out about, thinking it killed any reason to hold USDC. But just look at what's explicitly allowed. Rewards based on activity. Using USDC for payments, for sending money overseas, for loyalty programs, or for using it in DeFi, all of that is perfectly fine. But more importantly, this rule has almost zero impact on how Circle actually makes its money, which is what we're getting to right now. This is where the market just got it so wrong. So let's forget about the legislative drama for a minute and pop the hood on Circle's actual business. Forget the hype, forget the panic about paying yield to holders, because we are about to look at the incredibly simple, incredibly powerful, and wildly profitable engine that shows how Circle is already generating billions in revenue. I mean, just look at this chart. This tells you pretty much everything you need to know in one picture. In the last quarter of 2025, a mind-boggling 95% of Circle's total revenue came from one single source: reserve income. That tiny little 5% sliver, that's everything else. All their new products, their software subscriptions, all of it combined. This is not a complicated business. It is ruthlessly focused, and as we're about to see, it's incredibly scalable. And the thing the market panicked about, yield paid to holders, it's not even on this chart because it has nothing to do with Circle's revenue model. So what in the world is reserve income? Well, it's actually one of the most beautiful and time-tested business models in all of finance. For every single USDC that exists, Circle holds one real US dollar in super safe, high-quality assets. The vast majority of this is in short-term US Treasury bills. Now, those government bonds pay interest. Circle simply collects all of that interest. That's their revenue. The people holding USDC don't get that yield. What they get is a stable, reliable digital dollar they can send anywhere in the world 24/7. Circle gets the interest on that giant pool of money, often called the float. It's the same model that has made fortunes for banks and insurance companies for centuries, and now it's been supercharged by blockchain technology. And the scale of this money machine is it's breathtaking. In the fourth quarter of 2025 alone, that simple model generated $733 million. Let me just say that again. That is not for a whole year. That is for just 3 months. That's a revenue run rate of nearly $3 billion a year just from this one thing. And on top of that, it was up 69% from the same quarter last year. That's explosive, accelerating growth. So what's driving that insane revenue number? It's this one right here. At the end of 2025, there was over 75 billion USDC in circulation all around the globe. That means there was a $75.3 billion pool of reserves, mostly in Treasuries, just sitting there earning interest for Circle, 24 hours a day, 7 days a week. It's a really direct and powerful equation. The more people and businesses that use and hold USDC, the bigger that reserve pool gets, and the more high-margin revenue just flows directly to Circle's bottom line. The growth of USDC in circulation is the single most important number for this whole company, period. Now, of course, it's not all pure profit. To get to that $75 billion number and become such a core piece of the crypto world, Circle has a really important cost: revenue sharing. They've got these deep partnerships with huge players like Coinbase and other big exchanges and wallets, and they basically give them a piece of the interest they earn as an incentive to make USDC the go-to stablecoin on their platforms. It's a classic and very smart growth strategy, right? You give up a little bit of your margin today to lock in market leadership and build a much bigger, much more defensible business for tomorrow. Okay, this table lays out the whole financial picture, and it's probably the most important slide for any serious investor to really wrap their head around. Let's just walk through it. Top line, there's our $733 million in reserve income, up 69%. Next is other revenue. It's small right now, only $37 million, but look at that growth. More than 10 times what it was a year ago. This is where their new tech services and enterprise products are. Think high-margin, recurring software fees. So that gives us a total revenue of $770 million. Now, here's that critical cost: $461 million in distribution costs paid out to partners. So what's the real take-home number for Circle? It's that last line, RLDC. That stands for revenue less distribution costs. It came in at $309 million for the quarter, and just look at that growth, up an incredible 136% year over year. This is the core profit metric, and it is absolutely on fire. Okay, so now that we actually understand how the business works, this powerful, scalable, highly profitable float model, let's go back and look at that piece of legislation that caused all the panic. In this last section, we're going to lay out the full bull case and argue that the Clarity Act, far from being a threat, is actually the single biggest long-term catalyst this company could have asked for. So how is this scary bell a win? Well, it happens in 4 logical steps. First, and this is the big one, it provides full regulatory certainty. For years, the biggest dark cloud hanging over Circle was what the government was going to do. This bill just gets rid of that risk, cementing USDC as the government-approved, fully compliant digital dollar. Second, this unlocks the holy grail, bank and institutional adoption. The big financial players have been terrified to touch this stuff because the rules were so murky. This bill gives them a clear, legal safe harbor to hold, distribute, and build on USDC for everything from global payments to managing their own treasury. This doesn't just grow the market, it could 10x the whole addressable market. Third, the strict rules on reserves and audits create a massive competitive moat. It makes it super hard and expensive for new sketchy competitors to pop up, which favors established, regulated companies like Circle. And finally, the most important point of all, their core economic engine, that reserve income money machine, is completely untouched. And hey, you do not have to take my word for it. The CEO of Circle himself came out this morning and called these new regulations another significant unlock for the business. The people running the company, the ones with the most to lose, they don't see this as a problem. They see it as the green light they have been waiting years for to finally go after the biggest financial institutions in the world. The market's reaction today was fear based on a misunderstanding. The long-term strategic reality? It's a massive opportunity.
Okay, let's pull all of this together. We've deconstructed the panic, we've decoded the law, and we've done a deep dive on the business model. So now, let's arm you with the key takeaways and, just as importantly, the real risks, so you can start to form your own investment thesis on Circle.
So the central question is this: is this stock oversold? I mean, our analysis suggests that a 19% drop was driven almost entirely by a misreading of one clause in a new bill, while totally ignoring that the rest of that bill actually de-risks and strengthens Circle's core business for the long haul. To me, that looks like a classic, dramatic disconnect between negative market sentiment and what look like very positive company fundamentals. So here is your framework for thinking about this going forward. The bull case is simple and powerful. Regulatory clarity opens the floodgates to institutional money, which drives USDC circulation way higher and scales that already profitable model to the moon. The bear case, though, is real and you have to respect it. The biggest risk by far is macroeconomic, falling interest rates. If the Fed starts cutting rates, that directly reduces the yield Circle earns on its reserves, and that will hit their top line, no question. Another risk is a new, well-regulated competitor, maybe from a giant bank, that comes in and eats their lunch. So what should you watch? 3 key metrics. Number 1, above all else, is USDC circulation growth. That drives the whole business. Number 2, the RLDC margin. Are they keeping a healthy cut after paying their partners? You want that to be stable or getting better. And number 3, other revenue growth. Can they build out that high-margin tech business to diversify their income? These 3 numbers will tell you the real story of where Circle is headed. And of course, here's our mandatory disclaimer. This is not financial or tax advice. All the data we talked about today is from public filings and market sources as of March 24, 2026. This is for informational and educational purposes only. You should always do your own research and think about your own situation before making any investment decisions. So now, I really want to turn it over to you. What's your take on all this? Does this look like a massive overreaction, a fantastic buying opportunity created by short-term confusion? Or are the risks like falling interest rates or future competition just too high for you? Let us know down in the comments. Are you buying this dip on CRCL, or are you staying on the sidelines for now? If you found this deep dive helpful, please do us a favor and subscribe, like, and share ValueVest Daily. We put out daily insights to help you learn before you put your money to work. And one more thing. Please put in a comment if there are any specific high-risk, high-reward opportunities you want us to deep dive into. I read every single one of them. Thanks so much for watching, and I will see you in the next explainer.